S&P 500 Index SPX, long-term, chart analysis. Last week we wrote, Monday started the week with heavy selling. So bad that VIX reached 65.67. But on Tuesday stocks roared back to life, so the future remains a bit foggy. This week was a dramatic reversal from the prior week's selling. The S&P 500 Index, SPX, added a strong plus 3.92%. The SPX is back above its 50-day moving average line, which had not been broken since April 2024. But the 200-day average line appears to have stopped the selling. The conservative S&P 500 strategy is designed to protect investors from bear markets. Short-term declines are endured and should not trigger sell signals. The aggressive report follows short-term indicators in more detail. The conservative strategy is based on long-term chart analysis and does not make changes based on emotions, news events, etc. This is a long-term strategy. It is designed to allow fluctuations in the market and not try to market time every little up and down. The strategy is very long-term oriented. We are in a bullish position in the Rydex S&P 500 Nova Fund, RYNVX, or other S&P 500 Index Fund or ETF such as SPY. S&P 500 Index, SPX, and current chart analysis. Last week, the U.S. stock market sold off Monday as part of a global market sell-off centered around U.S. recession fears. The most important aspect of the selling was that it generated extreme fear. The CBOE Volatility Index, VIX, painted a dramatic picture of the fear. Last week we wrote that we have never seen a bear market with strong breadth. The stock market sold off so quickly in very early August that many were calling it a market crash. And yet, breadth was holding near its highs. So intense was the selling that the CBOE Volatility Index, VIX, soared to over 65.0 as investors bought insurance in the form of options against further declines. Something new for the textbooks? Something new for market technicians to look for? A market sell-off with most stocks staying near their highs. This week the stock market taught us that nothing has changed. Fear can cause stocks to drop quickly. Fear can cause VIX to rise dramatically, in fact higher than it had reached since early 2020. When breadth stays high, the rest is just fireworks. Lots of bright fires, selling, panic, that quickly burn out. This week was the reverse of the prior week. A bearish start for stocks in August doesn't necessarily point to something worse for the rest of the summer. Inflation data, including Tuesday's Producer Price Index, showed that wholesale prices increased 2.2% in July on a year-over-year basis, down from 2.7% in the prior month. Yields are down, stocks are up, based on expectations that the Federal Reserve will be able to cut interest rates next month. Our S&P 500 Index, SPX, strategy is within a day or so of issuing a bullish signal. This correction was strong enough to trigger exit to cash signals in almost all of our strategies. But next week should see most of the strategies back in bullish positions, assuming the rally continues. Tuesday's milder than expected reading on producer prices in July was translating into fading concerns about inflation by many market participants and reinforcing traders' expectations for multiple rate cuts from the Federal Reserve into mid-2025. Fed funds futures traders were gravitating toward the likelihood of 2 full percentage points of reductions in interest rates by July of next year, which would take the Fed's main interest rate target down to around 3.25% to 3.5% from a current level between 5.25% and 5.5%, according to the CME FedWatch tool. Retail sales shot up 1% month-over-month, well above the highest forecast. That is the biggest month-over-month rise since January 2023. And yet over 10% of credit card outstanding debt is over 90 days delinquent. The share of consumers with a delinquent credit card has increased rapidly since 2021 and is now higher than in 2019. While consumers with delinquencies clearly show signs of struggling, news reports have taken the rising delinquency rate as a sign that financial distress is becoming more widespread, suggesting underlying weakness in the U.S. economy. All this is pointing to rate cuts in coming months. Whether or not there's a recession, the American working and middle class feels like it's in a recession, former CKE Restaurant CEO Andy Puster said. And I think that's probably more important than whether or not economists determine there's a recession. Breadth never declined during the market crash in early August. Now it is back to new all-time highs. Market-moving economic reports released this week. U.S. consumer inflation expectations for the year ahead were unchanged at 3% in July 2024, the same as in June. Year-ahead commodity price expectations declined for gas, minus 0.8 percentage point to 3.5%, and food, minus 0.1 percentage point to 4.7%, but rose for medical care, plus 0.2 percentage point to 7.6%, college education, plus 1.9 percentage points to 7.2%, and rent, plus 0.6 percentage points to 7.1%. Factory gate prices in the U.S. rose by 0.1% in July, slowing from the 0.2% increase in June and less than market expectations of a 0.2% increase. The core PPI was unchanged from the prior month against expectations of a 0.2% rise. The muted increase raised bets of a softer CPI print, backing expectations of a Fed rate cut next month. The NFIB Small Business Optimism Index in the U.S. rose to 93.7 in July of 2024 from 91.5 in the previous month, the highest since February of 2022, when the Russian invasion of Ukraine triggered commodity supply shocks and inflationary pressures across major global economies. Still, it marked the 31st consecutive reading below the 50-year average of 98. The average contract interest rate for 30-year fixed-rate mortgages with conforming loan balances, $766,550 or less, edged 1 basis point lower to 6.54% in the week ended August 9, 2024, a fresh low since the first week of May 2023. Data from the Mortgage Bankers Association showed interest rates have fallen 46 basis points in the last 5 weeks, tracking a decline in Treasury yields amid bets the Fed will start cutting interest rates next month. The annual core consumer price inflation rate in the United States, which excludes volatile items such as food and energy, eased further to an over 3-year low of 3.2% in July 2024, down from 3.3% in the prior month, in line with market forecasts. Consumer Price Index CPI in the United States increased to 314.54 points in July from 314.18 points in June of 2024. Consumer Price Index CPI in the United States averaged 124.38 points from 1950 until 2024, reaching an all-time high of 314.54 points in July of 2024 and a record low of 23.50 points in February of 1950. Retail sales in the U.S. soared 1% month-over-month in July, following a downwardly revised 0.2% drop in June and way better than forecasts of a 0.3% gain. It is the biggest increase since January 2023, with sales at motor vehicle and part dealers rising the most. The number of people claiming unemployment benefits in the U.S. fell by 7,000 to 227,000 on the week ending August 10, contrasting with market expectations of a slight increase to 235,000, marking the second consecutive weekly decline since reaching a near one-year high of 250,000 in late July. It was the fewest amount of new claims filed in 5 weeks, challenging recent data that reflected a marked slowdown in the U.S. labor market, and adding some leeway for the Federal Reserve to not loosen monetary policy at a magnitude that jeopardizes the fight against inflation. The NAB Wells Fargo Housing Market Index in the U.S. fell to 39 in August 2024, the lowest level so far this year, from a downwardly revised 41 in July and below forecasts of 43. A lack of affordability and buyer hesitation stemming from elevated interest rates and high home prices contributed to the continued decline in builder sentiment. Building permits issued in the United States fell by 4% from the previous month to an annualized 1.396 million in July, while housing starts plunged by 6.8% to 1.238 million. Both indicators missed their estimates and dropped to their lowest since 2020, adding to pessimism over insufficient housing supply in the U.S. The University of Michigan consumer sentiment for the U.S. rose to 67.8 in August 2024, up from 66.4 in July and above forecasts of 66.9, preliminary estimates showed. It marks the first increase in 5 months. Overall, expectations strengthened for both personal finances and the 5-year economic outlook, which reached its highest reading in 4 months, consistent with the fact that election developments can influence future expectations but are unlikely to alter current assessments. Conclusion. The SPX position in this strategy is bearish. Aggressive traders should be in cash, money market funds. Comprehensive S&P 500 Index, SPX, long-term chart analysis. Last week's market recap. Last week began with a tumultuous Monday marked by heavy selling, sending the CBOE Volatility Index, VIX, soaring to 65.67. However, the market rebounded robustly on Tuesday, leaving the future outlook uncertain. This week in review. This week saw a dramatic reversal from the prior week selling, with the S&P 500 Index, SPX, surging by plus 3.92%. The SPX successfully moved back above its 50-day moving average, a support level that has remained unbroken since April 2024. The 200-day moving average line appears to have halted further selling, suggesting a potential stabilization in the market. Conservative versus aggressive strategies. The Conservative S&P 500 strategy aims to shield investors from bear markets, enduring short-term declines without triggering sell signals. This long-term strategy avoids making decisions based on emotions or news events, focusing instead on enduring market fluctuations. Current chart analysis and market sentiment. Last week was characterized by a global market sell-off triggered by U.S. recession fears. The CBOE Volatility Index, VIX, painted a dramatic picture, reaching over 65.0 as investors sought insurance against further declines. Remarkably, despite the intense selling, market breadth held near its highs. This week's market activity reinforced the notion that fear can cause rapid sell-offs and spikes in VIX. However, strong market breadth and quick rebounds suggest that the underlying market strength remains intact. Despite a bearish start in August, inflation data and other economic indicators are pointing towards potential Federal Reserve interest rate cuts next month. Economic indicators and market implications. This week's economic data reveals a mixed bag of signals, market-moving economic reports released this week. Several key economic reports influenced market sentiment this week. Conclusion. The current strategy for the SPX is bearish. Aggressive traders are advised to remain in cash, money market funds. The economic data and market indicators point towards potential rate cuts by the Federal Reserve, but the market's strong breadth and quick rebound suggest that the long-term outlook remains cautiously optimistic. By staying informed and adapting to market conditions, investors can better navigate the complexities of the S&P 500 index. Whether adopting a conservative or aggressive strategy, understanding the underlying market trends and economic indicators is crucial for making informed investment decisions.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.